Good morning, everyone, and thank you for joining us today for our webcast entitled Sustainability and Liquidity in a Crisis. My name is John Usanio. I'm a partner and practice leader at Citrin Cooperman's not-for-profit industry group, and I'd like to welcome all of you to this seminar. Before we begin, and on behalf of Citrin Cooperman, I want to extend our sincerest hopes and best wishes that you, your families, and your friends are all staying healthy and safe in these uncertain times. The effects of the coronavirus are first and foremost a true human tragedy at a global level. It continues to disrupt society at not only the community and personal level, but also at the economic and business level as well, with both immediate and long-term consequences and repercussions anticipated. Businesses of all types, whether they be for-profit or not-for-profit, are grappling with the current events and how to best adapt in these times. For not-for-profit organizations, the challenge of ensuring financial sustainability has always been an ever-present issue. In times of crisis, when communities and constituents seek out programs offered by not-for-profits to aid, it becomes even more difficult to navigate the operational and program missions. The ability to maintain cash flow and to meet financial obligations are often tied hand in hand with unpredictable levels, and in times of crises, unfortunately, with declining levels of support, as it relates to contributions, conference revenues, governmental support, and other fundraising efforts. Coupled with the strains of entities experiencing remote workforces now and limitations on public gatherings, the landscape that not-for-profits are traversing has never been more difficult. Not-for-profits must continue to forge forward in these challenging times with timely and appropriate actions to ensure short-term and long-term sustainability, not only for its financial and operation well-being, but also for its programs and missions. In an effort to assist our clients, and as well as the community at large, we are assessing the pandemic's changes and challenges it has brought to the not-for-profit sector. As such, we invite you to participate in our survey and share it with others as well so that we can have a reflective and representative sample for analysis. The survey, we anticipate, should take no more than 5 to 10 minutes to complete, and we will be sharing the results as well as all of the thought leadership that is gathered from that information to you. Today's webcast, which is our fourth in a 5-part series, dives into some of the considerations regarding sustainability. In particular, our agenda will be focusing on an update regarding certain governmental programs and legislations, sustainability factors, cash flow modeling and forecasting insights, and an overall discussion on plans of actions and strategies. This webcast is being recorded for future playback. We encourage you to ask your questions utilizing the Q&A feature in the toolbar settings. We have planned for a Q&A towards the end of the webcast, but we'll try to respond to your questions as we receive them. And with that, I'd like to turn this meeting over to Mark Sonnenberg, a partner in our Long Island office and moderator for today's panel. Mark?
Good morning, everyone. Hope everyone's doing all right. Before we begin on our content, we wanted to spend a few minutes just providing an update on some of the programs and some of the guidance that we've seen out there. First and foremost, the first round of the Payroll Protection Program funds ran out last week after only 12 days. The Senate on Tuesday approved a $370 billion program in additional funding for small businesses. The relief bill has passed in the Senate, and at this point in time, it's moved to the House, and we're very hopeful to hear something today. And it does appear that a large portion of these funds will be used to replenish the funds that ran out from the Paycheck Protection Program. We would recommend that if your organization did not make the first round of funding, that now would be a good time to check in with your banker or your financial institution to see where they stand. From a news perspective, as I'm sure many of you have heard, it's been reported that some very large companies such as Shake Shack and other large restaurant groups incorrectly received millions of dollars of funds and were required to return them. The PPP program was intended to benefit workers at businesses and nonprofits with fewer than 500 employees that are really unable to obtain credit elsewhere. So there were some obvious flaws in the program, and we're very hopeful that this next round does have some improvements. In regards to the possible forgiveness of the Payroll Protection Program funds, we're still waiting on guidance on how the mechanism of the possible forgiveness of the program will work. However, we wanted to point out that our firm is working on a forgiveness calculator that is going to reside on our firm's website. You can feel free to visit our website and check in on this. It's still not up and running yet, but this will be a nice tool for you to have an idea as to the possible funds that your organization could be forgiven. And just as a reminder that expenses qualifying for forgiveness must be spent within 8 weeks of receiving the funds, and only certain expenses qualify for the purpose of the forgiveness. And just one other Q&A that kind of came out on the last day or so is that if you do receive funds in several tranches, we've been hearing that sometimes organizations receive 1 or 2 or even 3 tranches of funds, that 8-week period starts once you receive your first tranche of funding. Additionally, out there is the Employer Payroll Tax Deferral Program. So there's been some further guidance that was released over the past week or so on this program. In general, this program allows employers to defer 100% of the employer portion of payroll taxes. It's important to note that this is a deferral program. It's not a forgiveness type program. And the main purpose is to provide some sort of short-term liquidity to organizations that need it. The deferral applies to payroll taxes due for the period beginning on the date the CARES Act was signed into law, and it ends on December 31, 2020. Half of the deferred payroll taxes are going to be due on December 31, 2021, with the other half is going to be due on December 31, 2022. Finally, for the organizations that did not apply or receive funding under the Payroll Protection Program, one alternative is the Employee Retention Credit. In general, if you have a significant decline in gross receipts in your organization in the first quarter of 2020 as compared to 2019, you may be eligible for this credit. This credit will be claimed on either your second quarter Form 941 or you can file IRS Form 7200. This credit is taken against the employer's share of federal taxes, and it includes wages and certain health care costs, and is up to $10,000 per employee. And finally, we just want to recommend that new information is coming out daily, and everything seems to be evolving at an extreme rapid pace. And we would recommend that you speak to your advisor regularly to make sure that you're up to date on the latest information and how it could impact your organization. Additionally, feel free to regularly check on our firm's website the COVID-19 response unit, which will have the latest alerts that are being published at our firm pretty much on a daily basis. So that's the update that we wanted to share. And with that being said, we're going to start our discussion over sustainability and liquidity. And just a brief introduction of our presenters. Along with John Eusenio, we have Brian Gigante. Brian's a partner from our Bethesda, Maryland office and have served the nonprofit industry for more than 40 years. We have Alex Reagan, who's a partner in our Braintree office and has more than 20 years of experience in supporting New England's nonprofit community. And additionally, for this presentation, we have Kieran Higgins, who's a manager in our firm's business process outsourcing practice. Kieran has significant experience in financial projections, pro formas, budgeting, strategic operations, transfer pricing, and revenue cycle management. Next slide, please. So with that being said, I'd like to pose our first question of the panel to Brian. So Brian, the word sustainability is a word that we hear regularly on the news, in articles and in white papers, and is applied to many different situations. How do you see that term being used today?
For today's discussion, I would equate sustainability with the survivability of a not-for-profit, not just in terms of today's environment, but on a strategic level as well. Although it would be easy given today's unusual times, I would not suggest we take a doom and gloom standpoint. Rather, from an organizational standpoint, we should be looking at what an organization can do to, one, maintain a certain level or rate of operation, regardless of the circumstances, and two, avoidance of the depletion of resources in order to ensure a balance between our mission and our organization. Certainly, this is a tough area for a lot of organizations. I saw a recent study the other day that said 77% of nonprofits are experiencing high level of disruption in their ability to provide services. 78% of them are having a disruption of their ability to generate revenue. 60% have increased and sustained staff and voluntary absences. But at the same time, there's a 44% increase in the demand for services. So again, this is both a short-term and a long-term opportunity for an organization to address sustainability.
All right, thanks, Brian. And I guess given that starting point, what should an organization use when evaluating sustainability?
Okay, so when we're talking about sustainability, for a frame of reference, we're talking about three aspects. We're looking at the economic effects, we're looking at the social effects, and we're looking at the environmental effects as well.
All right. Well, that's great. Well, what factors should we consider in putting together or updating a sustainability plan for an organization?
Sure, Mark. In a few minutes, Kieran will provide an example of how to use the model this analysis. But now let's talk about what should go into the decision process. If you're familiar with the song Amazing by Aerosmith, there's some words in there that says life is a journey, not a destination. And so it is with a sustainability plan. It's an evergreen document that gets changed all the time. I'm sure not evergreen. It's a changing document and something that every organization should be doing if it hasn't already been done it. I know it's easier to say to do something such as this than do it. But I think an organization pointing its boat in the right direction is the way you want to go. So when we're talking about economic effects, what we're talking about is what resources does our organization currently have? You know, we have to look at net assets and reserve, both those with and without donor restrictions. We need to look at our funders and major contributors. And are there strategic partnerships we should seek out? Certainly now there are other organizations in the same boat, and rather than being competitors, again, there may be a good opportunities to be strategic partners at this point in time. The second thing you need to do is look at what funding do we reasonably expect to receive in the next 12 months to 5 years. We have existing grants and awards. You know, will we continue to receive those grants and awards? How likely are they to continue? I know in talking with many of my nonprofit organizations, most of the people that have existing grants and awards have said they will fulfill those remaining grants and awards, but given the decline in the market, given decline in I guess, social services, they're not so sure about future opportunities. But we also should be looking at new opportunities as well. If we watch the news every day, we see all kinds of businesses modifying their business plan and their mode of operation in order to, you know, serve the public. Not a nonprofit, but there's a local food distributor that used to supply food to restaurants in our area. Now they're going direct to consumer on that. So again, it's just looking for those opportunities, trying to see what we can do in order to keep our operations going. And then we have to look at what events will we be able to continue to provide, which events need to be changed or dropped, and what alternatives do we have. And then we have to look at our fundraising efforts, both those who are planned and unplanned, and see what we can do to continue and even improve on them. The next thing we need to look at from an economic effect is what are our fixed expenses? Is it rent? Is it other leases, communications, other existing obligations for events and meeting? And we really need to take a good hold of those and say, what do we need to continue? What do we need not to? What can we do to change in these type of things? And I know we'll talk about that a little bit later in terms of an action plan. But again, it's just gathering all those expenses and figuring out what makes sense to continue and what doesn't. And then what are our variable expenses? Are they programmatic? Are they overhead? And just really assess the economic effects on all of them. The other thing we need to look at is our social effects. What programs are essential to our constituents? You know, what programs are synonymous with the organization, or if that program was not continued, would cause irreparable harm to both the charitable class we're trying to serve, and to the organization itself. So if you look at it from a trade association standpoint, if they're unable to provide member benefits, then that really is going to bring the organization into scrutiny. If you're social services, what charitable class are you trying to serve? If it's educational, you think about your students, how we can continue to provide education in these unusual times. And if you're a museum or fine arts type of organization, how do you satisfy the needs of your patrons? And then the final factor would be the environmental effects. Given the widespread effect of COVID-19, is it even possible to deliver the goods and services that are needed? We need to think about innovative thinking and delivery channels. As I mentioned before, that produce company going direct to consumers is something that was completely unexpected, I think, for a lot of people. And if you're delivering services to the community, how can you protect your staff? Do you have adequate personal protection equipment? Obtaining that and having adequate supplies is a major challenge.
Thanks, Brian. You actually brought up a very interesting point in terms of the social effect on programs. I've seen with some of my clients that, they take a look at their programs in kind of two tranches, one of them being programs that are critical to their constituents and their mission, and the others that are programs that are there to actually make money for the organization. And sometimes those two are separated out, right? Some programs that are very important to an organization may not be profitable from a bottom line perspective, but I think Brian brought up a really good point that I think it's important to understand what the critical programs are to your organization, both from a monetary and from a mission standpoint, and make the decision by looking at the full picture. So I thought that was a really good point, Brian.
I agree, Mark. Thank you for that nice input.
Yeah, so moving on from that, so I'd like to pose this next question to Alex. So Alex, how does the current situation affect the organization's key metrics?
So as Brian had said, there's a lot of recalibration that has to occur, a lot of reassessment about who we are, the programs, how we're delivering the services and all of that. And with that, comes, a whole new perspective of looking at our metrics, how we're evaluating ourselves, and our performance indicators. One of the key things is liquidity. Liquidity has really become a strategic initiative, especially today. It's no longer just a measurement that we look at and a number that's calculated. It's really something to be managed and monitored. When an organization reevaluates themselves, their programs, and to the magnitude that we are today, it's really important to reevaluate the benchmarking tools and the metrics that we're using to measure ourselves given COVID-19 and just the whole fresh assessment of the organization. We have to think about things such as, are those metrics in the performance indicators meaningful or useful? It's important to also identify the key revenue streams and the trends and, how those are all impacted by this. So obviously, liquidity is such an important thing today. How are the cash flows of our key revenue streams being impacted by all of this? What does that mean to our operations on how do we have to recalibrate? So, what used to be your key metrics or key performance indicators before may not be the same ratios that are going to be meaningful or useful to you today. So important to also develop that new dashboard benchmark tool that you're going to use and develop it in such a way that you can do it timely, quickly, and with information that's handy so that you can use it more frequently than maybe you had in the past.
All right, John, did you want to chime in here?
Sure. Thanks, Mark. I think that just to add on to what Alex said, one of the things that you need to consider as you look at these KPIs or performance indexes that you're assessing to is the overall assumptions that are used in the data that is being utilized for those ratios or those analysis. As Alex mentioned, the times are changing, and unfortunately, as often is done, a comparison to prior years or a comparison to historical data, which is the starting point for many calculations and computations, just can't be relied on. there's with all the new events that are occurring and all the changes, both operationally and systematically, that are happening across all industries and all businesses, there's challenges in utilizing that data. So when you're projecting out or looking at your cash flow information or your assumptions that are used, I think having a fresh perspective, as Alex mentioned, is definitely going to be one of the key starting points.
Great, thanks, John. So Alex, just to build off of the last statement that you made, so just spend a few minutes discussing how obligations of an organization should be considered in a cash flow analysis.
Well, I think certainly one of the things to consider is certainly looking at the loan covenants that you may have out there and other regulatory compliance requirements that might be impacted by all of this recalibration. I think it's good to be proactive and look at the covenants and that you may have always met in the past that you might not meet. Be proactive to communicate with lenders timely, seek waivers when necessary, just kind of be in front of that. In the same vein, looking at your funding, look at the compliance requirements around that. There's a lot of different qualitative as well as quantitative regulatory requirements that you have to comply with, and just think about all of that and be proactive in the communication when you feel like you may be not necessarily compliant or going to meet them, given maybe some of the funding you're taking on, some of the recalibration you've had during this crisis, and whatnot.
Thanks, Alex. Yeah, so I think the covenants are really an important consideration, and outside of the financial covenant, but even from a financial statement timing perspective, I know many of my clients have requirements that they have to submit audited financials by a set period of time, and obviously we're all working remote right now, and many of the records that for your organization could be hard copies, so it could preclude the auditors to be able to come in and complete the audit on a timely basis. And I would strongly recommend that if you come into a situation where you feel that you're not going to be able to meet a timeliness covenant, that you reach out to your lender and your banker and start to have those communication discussions earlier than later. So the last question on this section, Alex, is should the board be involved in this process? What would you recommend there?
So absolutely. I think one of the common themes in everything that we've been talking about the last couple sessions today, always, everyone, is the fact that everyone's got to be so nimble and be able to recalibrate. And so it's not, business as usual, what we've always done. Speaking from the perspective of a board member myself, I know that the boards that I sit on, we're meeting more frequently. We're getting involved in some decisions that we've never had to be involved in before, and issues we've never seen before. So I think, the board should be involved. I mean, it's important also, as we talked about, looking at the metrics and redefining, what are useful key performance indicators, things like that, useful information. It's important to have accurate and timely information, a new package maybe for the board, be able to provide that timely, frequently, to help the board in their process. I mean, the board doesn't need to manage the process, but they are responsible for the actions and staff of the organization. So, it's important that an organization kind of maybe develop that package that can be given to the board timely, to help them make those decisions. I mean, in addition, there's, like I said, decisions being made now. I mean, as far as liquidity, there's, things that need to be voted on, maybe policies that need to be changed. In some cases, liquidity decisions are made related to endowments, which require board votes as they relate to maybe board designated amounts or restricted net assets by donors that maybe, we're in, a situation where we need to approach an attorney general or state board to repurpose. So those all involve, some kind of board vote as well. So those are considerations to be considered as far as being nimble, finding liquidity, and being able to make decisions quickly.
All right, thank you, Alex. That was a lot of great information there. So at this time, we thought it would be beneficial to actually go through a little bit of a model and some details. So I'd like to pass the presentation over to Kieran, who is going to spend a few minutes kind of going through a little bit of a model and talking just some specifics on cash flow projections. Kieran?
Thank you, Mark. Appreciate it, the handoff. You know, during the impact, as we move further into 2020 and the impact of COVID-19, we're beginning to feel the more and more uncertainty of just the global economy effect. So the pressures continuing to mount to help organizations understand their short-term and medium cash and liquidity situation. With that being said, clear and decisive cash forecasting, budgeting, reforecasting, and various scenario planning analysis will continue to become more of an effective tool to steer your organization through the situation. Understanding your sources and uses of cash through these complicated times will require your outputs to be just as effective as your inputs. Establishing clear lines of communication with your vendors, customers, employees, etc., will help yield accurate as possible results. While there is no silver bullet to solve all roadblocks, having the best measures and processes in place will be the most impactful as we continue to navigate the situation. The various examples the team has provided so far are exactly what you would want to be looking at to your considerations and the focal points of management as who you would want to be continued in these discussions. The proper use of cash forecasting and revised budgeting helps organizations strengthen these decision-making processes, helps you identify the potential shortfalls in cash needs, and provide you with the opportunity to proactively manage these potential situations. So being proactive in the situation rather than reactive. It is important for organizations to understand the sources and uses through these ever so complicated times, which require your output to be as effective as your input. Establishing these clear lines and keeping will help lead to yield the most accurate reports as possible. The consequences of inaccurate forecasts can be severe. You may not want to borrow more than you need to meet conditions. On the other hand, you may not want to leave funds unnecessarily idle. Our recommendation, or my recommendation, is starting with a rolling 13-week cash forecast, which roadmaps a clear vision from next week to the end of a quarter. The rolling forecast allows organizations to at a live level, stress test and adjust the forecasting underlying assumptions on a weekly basis, creating the ability to change in real time to the evolving business and nonprofit environment to maintain financial visibility. The financial visibility you can create with a cash forecast is imperative during this current situation. A cash forecast should be a detailed look at the organization's cash position relative to its inflows and outflows. To start, how much money will you be bringing in over the period in question and from what sources? This isn't a measure of your company's capacity to produce products or services, but rather what will be collected in payments for goods or services or events. How have the terms or relationships with your vendors or customers changed that it could affect the speed or the amount that you are paid for products or services? Internal organizations, in tracking them with KPIs, should be able to identify the patterns in debtor remittance that will allow for more accurate and nimble forecasting. No cash forecast should be set in stone. Particularly in this turbulent time, there are many customers who will begin to fail to pay, sales or events or grants that fail to materialize, or unexpected expenses that show up on your doorstep. Once an organization publishes a forecast, continue to monitor results in real time as much as possible. Doing this will allow you to identify the opportunities to improve your process and may permit you to take advantage of a better cash position on occasion. In front of you is this very simple 13-week cash forecast example. I've done these for a number of clients over a number of years, and I worked a long time in industry before I joined Citrin Cooperman and used it to drive the performance of my various cost centers at a very large health system. Starting from the top, these cash forecasts are customized to meet your needs. The week ended here in this example is 4/26. Now we know that's a Sunday, The client had requested, because that's the way, the easiest way of visibility for the client to measure its week performance. At the top, I have the actual results, and as you move forward with the cash forward on column B, I'm sorry, in week number 1, I have the payroll and the actual results. These numbers are hard coded in, which reflect updated information as the organization has received it. Moving towards week 2 to 13, they are projected. The payroll in the various weeks, corresponding weeks, is reflected at the top just as a guide to help the organization understand the ebbs and flows. For this particular organization, they have requirements by the board and a borrowing base certificate or loan covenant. The board requires the base to always be at $600,000. That is why the beginning cash balance here is at $600,000. Now, when we flow through the model, I'll give you various scenarios of how the borrowing base, they will go below the borrowing base. This organization is a small community nonprofit. They plan special events. One of the special events actually occurred 2 months ago. It was a bike ride. They were lucky to see some influx of cash this week from some of the former events. So that's the reflective of the $145,000 you see in the actual for week 1. In addition, they got very lucky this week and received a PPP loan. This is a very positive example of a cash forecast, and I like to fancy myself as a positive person. But if I was to subtract those two numbers, they would be below their borrowing base requirement by next week. And if I was to subtract everything for the life, as if no cash was coming in the door, they would be well below their borrowing base certificate through the middle of July, and reached about approximately $400,000. As I said, this organization has their sources lined up, and this is a very accurate, detailed look at their position as they understand it. They have a planned gift that has been in talks for a long time that's going to come in the middle of June. They have reconfirmed with this donor to make sure that that is going to come into fruition. Like I mentioned before, the special event was in January, and they've been able to see a special influx of additional cash from that. They have 2 additional events planned in the middle of the year. One is a community walk. The hope was that they could still continue as business as usual. What they're doing now is actually planning a virtual community event. So the plan is that the influx of cash will still exist during the weeks of May 24th and June 7th. They had, and they're lining up that success based on another event, virtual event that they've held in the past. So they have a very clear and concise understanding of how much success they could have with this virtual event. In addition, the next source is a city grant. This is a city grant they get annually from the city of Philadelphia. They've checked in with the city of Philadelphia just to be sure that they're going to still continue to receive this grant on an annual basis, and that the city had planned to give it to them towards the end of June. As I said, as I covered before, the PPP loan hit this week, which is a great stream of luck. They worked tirelessly to make sure that they could apply and receive that grant. Below are the uses or disbursements of cash. They're mostly fixed costs as is a relation to payroll and benefits. They have not laid off anyone, and they're continuing at the same run rate as they normally do. Now, if they have to break the borrowing base covenant and still satisfy their regular payroll and benefits, they are prepared to do so. The marketing is bi-weekly marketing is an ongoing effort that they continue through via Facebook, Instagram, and other sources that they need to maintain to further events. These promotional costs are examples of costs that they have to incur to make sure the events that they have in front of them go on as planned. Other event costs are almost in corresponding, but they're actually for events that are later down the line that they would like to continue before before they take them off the table. Now, with that being said, they could take some of this cash out of the equation if need be. As I mentioned, they would like to avoid breaking the borrowing base, but they're prepared to do so at the extent of keeping their current events continue and business as usual. As I said, this is a very positive example. I've been doing this with a number of clients and organizations across the country right now, and unfortunately the results aren't as positive as I would like them to be in this example. And organizations are getting below their borrowing base thresholds and or their liquidity threshold. The measurement of the net cash flows for that week are on the bottom, and you can see the cash flow. They don't have, typically organizations would like to have sources lined up that would meet their disbursements and have a positive impact on net cash flows. As you can see in this organization, there's various weeks of examples of examples of when their net cash flows are negative. Their ending unrestricted cash flow is the accumulation of the sources and uses and how they will continue to perform during this time. As I mentioned before, they'd like to keep their goal and initiative, and as it's been communicated to the board, is to stay above the borrowing base, but they are prepared if need to break it.
All right, so that was very helpful, Kieran. I'd say that the main takeaway, obviously, Kieran just went through some detail and just kind of gave a little overview of this organization. But for an organization to make good informed decisions, it's important to have the information at hand. It's virtually impossible for decision makers to make decisions if they don't understand cash that's going to be coming in and cash that's going to be going out. So I thought that was great. And a few minutes just kind of give an overview. So if you can picture you working with your particular organization, if you don't have information like this readily available, how you're going to go about making those tough decisions. And I guess, Kieran, just from an advice standpoint, when you're preparing a cash flow model, how much detail would you recommend that an organization goes into?
So that's a great question. The example I've put in front of you, as you can see, is a very simple, concise, and less detail than I would typically encounter when I build a cash flow. Now, the corresponding inputs to this cash flow model, I would typically break out the detail down to the penny for all uses of cash, whether it's payroll, benefits, marketing, print costs, promotional costs, or any other vendor payments that you want to take into consideration. So when I typically take a deep dive into vendors' expenses or organizations' expenses, my goal is to get the uses of cash down to the penny and down to the vendor detail level. And on the same side with the sources, I would typically have a budget for, and for this example, I would typically have a budget for each special event that would correspondingly flow into this. And I could update that budget depending upon the variables that we are going to encounter across the year. With that being said, the most important thing is to take a look at the various scenarios you could have. This example in front of us right now is actually the base case scenario. The best case would be a significant improvement upon this, and the worst case for them and as an organization is breaking the borrowing base covenant. Now, for other organizations, the sensitivity analysis around them will vary depending on how they currently lie. But it's going to change from organization to organization on how you want to look at this. Looking at from a healthcare perspective, I have a big revenue cycle management background. So I look at the actual billing and collections and on how I'm going to receive them. And in addition to that, that not only just changes your outlook from a financial level, but how you should be talking to your team operationally, because they're going to be the ones that are going to provide you with this up-to-date information on when the sources and uses, if the sources and uses, or how the sources and uses are going to come in. So it's a great question. This example I know in front of you is a simplistic approach, but my recommendation typically is to go to much more detail and carve out those three various scenarios as best, base, and worst, and provide extra feasibility or sensitivity analysis around the 13-week rolling cash forecast or a cash forecast, an annual rolling cash forecast.
Thanks, Karen. And final question, I would say, and you kind of alluded to it earlier. I guess just talk a little bit about the concept of budget reforecasting and how you recommend organizations take that concept to their organization.
So we do this a lot, and do this a lot as mentioned in the introduction. My background is really budgeting and forecasting, and I do a lot of capital planning, and my background is financial planning and analytics. So various, and as we alluded to earlier, there's various internal and external requirements of how you need to be looking at your financials. In a lot of my organizations that are in, say, the startup mode, they're constantly budgeting and reforecasting. And I think this is a great exercise and a really good exercise to take into consideration during times like this. And for example, what I would do if I was still in an organization, I would take my budget that I have in place, because 99.9% of our budgets are probably useless at this point. And I would reforecast the year at a 3+9 scenario. So I would take the results, the actual results from Q1, take them into consideration and rebudget my next 9 months. You can add trending analysis that compares you to what you originally budgeted, so you can see the delta of the net change. But as I mentioned before, a lot of budgets are going to be thrown out the window for now. And the same thing corresponding in a 6+6, taking the actual results and reforecasting the next 6 months, and a 9+3. I've had a lot of success doing this with organizations, and it's great that I've had the experience to do this, because now it's becoming more and more viable for most organizations who in the past wouldn't even consider. And as I mentioned, cash forecast is a tool. So once you build one, it's a tool for management that aids to the planning and strategy around your cash availability. And during this climate of complicated cash cycles, it's very integral to the decision-making part, component. Timing of capital expenditures. What are our annual capital plans, and how do they support our organization? When do we need to invest in capital? What is our payment plan associated with the investment capital? Managing working capital. When do we pay our vendors? When should we order the inventory? How are the customers' payment terms? Impacts of these new campaigns, financing, seasonality effects, and other changes in businesses when we should be investing in advertising. And like I said, all of these things are good considerations to bring to the table right now while we're in the current climate. So my recommendation would be to take a look at these in a, with a good methodology and a good foundation, and pulling all of the resources we mentioned before, your boards, the management and the various levels of support throughout the organization that can help you best forecast your cash position.
That was great. Thank you. John, did you want to add one item before we moved on?
Yeah, I think that Karen, that was a great overview on cash flow projections. And I think as you try and tie in liquidity and sustainability, one of the things that often is talked about is diversifying cash flows and different revenue streams. And those that can diversify and look at the different revenue streams, but also at the different program levels, is understanding how are you providing the greatest impact for your mission, or delivering on your mission and programs. And some of that oftentimes requires looking at the revenue streams and the expenses associated with those at a programmatic level, and being able to, in times of crisis, see where you might be able to make the most mission and programmatic impact, even if that means curtailing some other ones in the interim. So again, looking at cash flow holistically, but also by program, is something that I've heard a lot of nonprofits discussing in the community recently as well. So just wanted to add that in, Mark.
Great, thank you. Next slide, please. So before we dive into this section, I just wanted to address the question that came up, which I thought was a great question. The question reads, has there been any disclosure from the government on how much of the PPP funding went to not-for-profits? I have not personally seen that. I think that would be extremely interesting information when it does come into play. Kind of like what I said at the intro is the purpose of this funds were to get money to organizations that need it. And, you know, we've all seen some misuse of those funds at this point. So it'd be very curious to see the statistics when and if they are released. But that was a great question. So moving on to our last section of plan of action, and I'd like to start this off with Brian. So Brian, how would you decide which expenses are critical versus non-critical?
This, of course, would vary between organizations and would depend on many factors and would include both your direct and indirect expenses. And for today's discussion, I'll say direct would be your programmatic type expenses, and your indirect expenses would be overhead and a whole host of other expenses. And you really need to go through costs one by one to figure out, is it critical, is it non-critical, or is it mixed? For example, I would think most people would say communications are an indirect cost and would probably be, but could be very critical in terms of the organization, not just in terms of communicating with your staff, but communicating with your constituents, communicating with your board, communicating with your funders. And so it really would involve going through each major expense category and splitting them into those three categories. Now this would be expanded based on your circumstances, both on an organizational and programmatic basis. Like Kieran's example before, that was kind of a basic type of situation. You really should go down to this level of detail on major programs and major groups within your organization, and really involves understanding your cost on very well.
Yeah, and I thought that example that Kieran went through to kind of give a high-level snapshot in terms of an organization's budget is like kind of what we said. It's critical in the understanding process. So if you see that your organization is going to be having a significant cash flow shortage over the next 13 weeks, it's almost going to force you to make decisions in terms of cuts. But you're not able to do that if you don't have the information. So, you know, whatever methodologies that your organization uses to analyze your cash flow, I think it's really, really critical before you make decisions on what you're going to cut from a program or from overhead or management in general, to at least understand, you know, what are the sources and uses of cash that are going to be coming in the short term. So Alex, to build off of that, can you share with us what you've seen other organizations do to help combat the crisis from a financial standpoint?
Sure. So I think the biggest thing we're seeing is obviously the myriad of resources that are available that I think all my clients have taken advantage of under the CARES Act. So in the form of the PPP program or the EIDL loans, the payroll tax program, all of that, the various state and local funding. In addition to that, there's been some FEMA funding that some of my clients have gotten, just because their very programs are, what they do is just vital to relief efforts that are needed because of COVID-19. So, you know, they provided critical and essential services, which is the measurement for the FEMA fund. So that actually came into play. But just a lot of the, you know, a lot of resources from just COVID-19 relief funds in the PPP program. So that was a big one. I mean, in addition to that, you know, as we talked about, you know, just recalibration of, you know, figuring out, you know, budget cuts, your critical, your non-critical expenses, kind of recalibrating the budget, you know, finding some liquidity there, but also, you know, talking to lenders, postponement of long-term commitments. A lot of lenders, you know, let payments be postponed some months. The other big one, unfortunately, you know, staff and employees being the biggest cost of a non-for-profit. There was some, you know, restructuring there. So there's a lot of reduction in staff and maybe some furloughs and right sizing involved in some of the recalibration. Definitely deferral of retirement benefits, renegotiations with vendors on all kinds of different contracts and obligations, agreements. Again, you know, everybody's in this together. So, you know, renegotiations I found have been, everyone's been very open to that because everybody's in the same boat. You know what I mean? Everybody wants to be accommodating because everybody's affected. So I've seen a lot of creative renegotiations. Another big one is also seen a increase in COVID-19 appeals, given most of my clients have sent out additional appeals for COVID-19. Another big one that we've seen is repurposing of cash receipts that a lot of organizations have received, either for maybe prepayments on memberships or events, or some kind of prepayment that was to be recognized later or fulfilled later through maybe program or event. We've seen a lot of creativity going into options for those prepayments, where they've offered the donors or the customer or member the option of either deferring, applying the payment towards a future service, or just outright gifting it to the organization. So we've actually seen a lot of, things that we would have otherwise had to provide program services for become contributions as a result of that. There's business interruption insurance. I think that's something that's emerging now. It's important to check your insurance policies and see what your business, if you have one, in business interruption insurance, and what the provisions of that might be. That's been something that's been talked about recently, that even if they're denying claims, that something might happen later on that might get you some money under those insurance policies. And another one that I'm starting to see now, even with the markets the way they are, is, as I mentioned previously, that in some cases, organizations with endowments to create liquidity are either looking at board designated amounts that the board had designated for operating reserves or other board initiatives that really are needed now for other things. Enacted versions of MIFA allow you actually to temporarily invade permanently restrict corpus. So in some situations, some dire situations, people are looking at those options and being strategic about how they might draw down on an endowment. Some organizations are changing spend policy. That's not the ideal thing to do with the markets the way they are now, but maybe necessary. And in some cases, some organizations are looking at their what used to be permanently restricted or endowment corpus. And in the case where they're newer endowments and the donors are still living, they're actually going back to the donors and seeing if the donors will release those funds for a more unrestricted use towards operations to help them through this time. And in other situations, where the donors aren't living, it's involving the Attorney General or state board. So these are all very creative things that we're seeing out there, and they're necessary for viability, sustainability. And again, they're things that they're not things that we see every day, but they're certainly creative, and they're adding to liquidity. I don't know if you guys have seen anything else, so that was a lot, but it's covering a lot of different agencies too. So if you think about the nonprofits, not one model, you're also different. Some people are solely funded by state and federal contracts, others are funded by donations. So, the solution is a little different to everyone depending on how you're funded and from a regulatory standpoint, what you're allowed to retain, how you spend your money, and what your sources and uses are.
Thanks, Alex. A topic that we've actually gotten a lot of questions on comes down to financial reporting and other accounting considerations when you're receiving the PPP funds or other funds. I guess what factors do you think that an NFP organization should consider when receiving these types of funds?
So, okay, going to keep this brief because one thing to definitely consider, first and foremost, obviously the PPP program has provisions of forgiveness, right? So we all want to maximize that forgiveness, which will, include good record keeping and tracking. So you want to make sure that you're keeping records, all the rules about that forgiveness, and you're, maximizing that. Secondly, the other thing you want to consider is that these are technically federal funds. And, in looking how prior stimulus packages dealt with federal funds, like the ARA funds that came out in 2008, those are federal funds, and they were subject to uniform guidance audit requirements. So, this is all something to think about. Many of you are subject to these requirements already. Some of you have never had A133. It's something to think about, but we need more guidance from OMB to have a definitive answer about what are the compliance requirements. Will these be subject to uniform guidance, A133 testing, and what will that look like? So again, we are all poised and looking at this daily to see what comes out. We'll keep you posted, and we'll post something on our COVID Resource Center when we do have a definitive answer. But again, something to think about, because uniform guidance or A133 audits are compliance audits. So I just wanted to throw that out there. But again, with the PPP program, it's important to, again, work with your lenders. They have the rules. They have all the rules about forgiveness and compliance and all that for now, the definitive ones that you're signing when you close on those loans. So it's really important that you communicate and work with them. And also, reach out to, someone who's well-versed in federal programs, knowledgeable about federal programs, whether it's your auditor, and, anyone that you want to talk to about those kind of tips if you want to be well-poised to be in a good position to be compliant, should you be subject to those requirements.
Right. Thank you, Alex. So stay tuned on that. There'll certainly be more information and guidance that's going to be coming out. So we have time for one last question, and I'm going to leave this with you, Brian. So many nonprofits have programs that they think are untouchable. I guess, what are your thoughts on that?
So certainly most organizations have an untouchable program or two. I hope, given the circumstances, leadership, both governance and management, can agree with programs are truly untouchable, and which programs can be deferred and which programs can be cut. The best example I can see in the nonprofit world has been the cancellation of college sports events such as NCAA tournament and similar venues. These organizations make the right decision despite the economic and societal pressures they had to consider in making this decision.
Thank you, Brian. That was great. And I want to thank each of the panelists for helping us and providing their time and insights. And I want to thank all of you for joining us today as well. We hope you found the dialogue and information interesting and useful. The regulations and legislations, as we said before, are continuously changing and evolving on a daily basis. And we encourage you to stay up to date with the new tools and information as they get promulgated and clarified by the different agencies. And we encourage you to reach out to your providers and advisors with any questions or concerns you may have, and also to visit our not-for-profit webpage that has various thought leadership and content that you can utilize as you navigate these times. Our firm also has a COVID-19 response unit webpage that has up-to-date information, whether it be from SBA enactment or tax matters. And we invite you to join us on that page, and also on our final webcast for the COVID-19 series that we will be hosting next week on Thursday at 11 a.m. regarding resiliency and moving forward successfully. I do hope that you all have a great rest of the day, and please stay safe and healthy in these times. We look forward to seeing you on our next webcast. Thank you.